The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks.
Okay, so that was Jay Powell, the Fed chief, speaking today at the annual Jackson Hole Economic Symposium, signaling that the central bank is poised to cut rates in September. He didn't signal how large the move could be, but markets are reacting positively right now. Let's get perspective from our panel. Blake Gwinn, head of U.S. rate strategy at RBC Capital Markets, and Andrew Brenner, head of international fixed income at Natalliance Securities. Thanks very much for joining us, guys.
Thanks for having us.
Blake, could we kick off with you? Investors seem to be deciding, yeah, this cements it. He is going to cut rates on September 17th, 18th.
Yeah, look, I mean, we knew they were going to cut rates in September. I mean, we were priced, I think, around a 15-20% probability coming into the speech that they were going to go 50. So I think what people were really trying to figure out is if he was going to very strongly guide to one side or the other, either, you know, kind of fully commit to 25 or try to take 50 off the table or kind of leave that more open. You know, I don't think he really gave us, you know, he didn't take 50 off the table. He didn't really set it up. You know, for myself, I kind of feel like I know now exactly what I knew at 9:55 this morning, which is that, you know, if we're going to get to 50, base case is probably 25 now. And if we're going to get to 50, it's going to be through the NFP that we're getting in 2 weeks.
Andrew, was Powell in any way signaling that he's ready to do a 50 basis point cut if needed?
Well, what he said very clearly is he's much more concerned about employment now. So as Blake just said, it really tees it up for September 6th. So right now, it doesn't really seem like it's 50, but if that number comes in weaker than expected, there's no question in our minds that he's going to go 50 basis points.
And what is his worry here, Andrew, that the labor market weakens more than he expects?
Absolutely. No question about it. He's very concerned about the labor market. He said it a couple of times today. He's less concerned about inflation. He's much more concerned about labor. So that's where we have to watch what's going on. And we think that it will be very dependent as to whether he goes 25, whether the labor report will be very dependent on whether he goes 25 or 50.
Blake, is he trying to dispel any fears that the Fed has been too slow to cut interest rates, is behind the curve, as the expression goes?
Yeah, I don't think they're as worried about that. I mean, that's been the big narrative over the last 3 weeks. You know, the Fed is behind the curve. You know, I kind of wrote a couple weeks ago, that's fine if you actually know where the curve is. I think that Powell in particular, much more than his predecessors, Bernanke and Yellen, has very little faith in some of these kind of academic models that purport to kind of know where short-run neutral is. I don't think he really knows where short-run neutral is, or at least he admits that they don't know. And if you don't know where you're going, you know, I don't really know what the rush to get there is. I think they look at the risks on the downside of the employment side. You know, they're certainly there. I don't think we see anything looking across the constellation of data. I don't think we see anything particularly pressing, you know, that's suggesting kind of a near-term deterioration. And so, you know, I think they have plenty of ability, and they have the luxury to start paring back the restrictiveness of rates in a gradual fashion. So I think that's kind of where he's coming at it from, is this kind of, you know, having the ability to kind of take your time and not really being pressed, you know, not really being pressed yet to have to triage the early stages of a recession.
Andrew, broadly speaking, are long-term government bonds a buy now, U.S. 10 years?
I don't think they're a buy right here. I believe that they'll go back and fill. I would certainly look to buy 10 years above 4%, maybe 4 1/8, but I wouldn't buy here. To Blake's point, I really think that inflation using the PCE is somewhere between 2.5 and 2.7 and trending downward. Given that, and given my view of 150 basis points over that, I think we should be more at 4% than at 5 3/8. And even with a 25 taking off the table, I think they have to go probably between 4 and 5 times, or between 100 and 125 basis points between now and the end of the year,
Whoa.
just to get somewhat neutral.
That's interesting. So you think, sorry, to get neutral, so interest rate policy isn't slowing or speeding the economy, he'd have to go a whole 1.25 percentage points?
That's my view. And that is, and I'm not the only one out there that sees it that way. There are plenty of large banks that agree with it. They're either at 100 or 125 right now. So, we'll have to wait and see. If the economy continues to slow down like I think it will, but of course you do have retail sales and other numbers that come out stronger, but some of that could be explained away by the Amazon Prime days and so on and so forth. A lot of these things get tweaked. And if you look at the non-farm payrolls, the revisions earlier this week, which were butchered by the Labor Department, you're talking about 818,000 less jobs than were already reported. And while we knew some of that, I really think things are a lot weaker than the Fed realizes. I believe Powell realizes it, but I don't think the rest of the Fed really does.
That's interesting. Now, just on the timetable here, so September 17th and 18th, Blake, is the next time they're scheduled to announce interest rates. Is that right? We could have to wait that period. It's almost a month before we get a reduction in rates?
Yeah, that's when it's coming. That's their next meeting. It's not going to be an emergency. They're not doing anything emergency or intermeeting. There's a little bit of talk about that post NFP, but that's just not a realistic option in my view. So yeah, we'll have to wait till that meeting. I think the more interesting thing is that meeting, we will get SEP dots, which the September SEP dots are always very interesting because they only cover the last two meetings of the year, the 2024 dots. So they're going to have to pretty much tell you what they're expecting to do in November, December at that September meeting. So we're not just going to learn about whether it's 25 or 50 in September. We're also going to get a pretty good idea of what they're doing in November, December, just because those dots now only cover two meetings. It's a little bit more ambiguous when you're in June or March. That 2024 dot covers a whole slew of meetings. It's a lot harder to kind of back out what that means for any given meeting, but we'll pretty much know in September what they're doing, what they're planning for the rest of the year.
Andrew, is there anything investors are missing here? You say that it's interesting. You say that Powell realizes the labor market is weak. The other members of the Fed Open Market Committee don't necessarily realize how far things have gone. But is there anything else investors are missing in this story? Is there some kind of an iceberg here that the market could run into?
Absolutely. I'm glad you brought that up. I think the iceberg is the yen carry trade, because what happens is now this morning you had the BOJ head talk to Parliament and say that they still plan on on tightening, whereas the Fed is easing. So that is really crushing the dollar versus the yen. Last I looked before I went on the show, it was 144 and change. So as it goes a little bit further, as the Fed cuts interest rates more or the BOJ raises or both, I think the yen is going to be a problem, and it's going to cause a lot of unwinding of the yen carry trade and a lot of risk off. So I think Powell has to be careful about that. So that's the one thing. That's the iceberg that I'm thinking about.
That's interesting, yeah, because we've heard people discounting the yen carry trade, but you think it could still cause mischief. Blake, what about you? Is that a risk for the market? The yen, obviously the yen goes up and it makes it far less palatable to own Japanese-denominated debt.
Yeah, I'm with you on that downside risk, but I'll actually take it in a slightly different direction and give you a risk to the upside, because I have a more sanguine view on kind of labor markets, on the economy. And I think if you ask what the markets are missing, I actually think that maybe we've gone too far in kind of discounting any upside. I look at what we're getting in kind of the labor data. I think there were some, what we've seen in the unemployment rate has been driven to some extent by kind of shifts in the makeup of the labor force. And then in this last print, I think there were some very, very weird things happening in the seasonal adjustments that drove up temporary layoffs. I wonder if that could unwind in a pretty big way in the next print. As far as the revisions, I think for sure payrolls numbers were probably overstating jobs, but now I think these downward revisions are actually understating them just because of the way those revisions rely on claims data, which does not cover a lot of the kind of impacts from immigration we've seen. And lastly, I would just say on inflation, we saw that shelter component, the all-important shelter component that we've kind of been hinging this disinflationary trend on for the second half. That actually popped up in the last print. So, it's not our expectation that inflation is going to pop back up. We're, like I said, we're more sanguine on the labor markets, but I think there could be a swing of the pendulum back in the more positive direction for the remainder of the year.
What about trends in the actual labour market, Blake? Could you remind us very quickly what's been going on with the participation rate? Because obviously if more people are looking for work or entering the labour force, that can exaggerate unemployment.
Yeah, it's pretty interesting. I mean, we talk a lot about the Somme rule and we look at these kind of past recessions when the unemployment rate has started ticking up. Oftentimes those are driven by people getting laid off. It's people losing their jobs. There have been times when supply has been an impact, but usually you're seeing layoffs start to ramp up into those Somme rule triggers, into those recessions. This time, almost the entire rise in the unemployment rate that we've seen up until this last print has been new entrants coming into the labor market without jobs. And that's generally been in the 16 to 24 type of cohort. Prime age employment remains very, very strong. I think to some extent, if I had to guess what that's looking at, I think a lot of people, delayed going to college, people enrolled in grad school during the pandemic. Maybe they're getting out, takes them a little bit of time to find a job. So they're kind of now getting picked up in the unemployment rate. To me, the dynamics around that are very different than people losing their jobs, because that has a very deleterious effect, I think, on people's spending and consumption. If you see your friend losing his job, you start to think, well, maybe I shouldn't take that vacation. Maybe I shouldn't, buy a new car. And if it's really just an 18-year-old I should say a 23-year-old who decided to go to law school during the pandemic, who gets out and can't find a job right away, that's not really having those same kind of impacts on the psyche and kind of the the behavioral aspects of that. So I think that's just the rise in the unemployment rate we've seen. When you look at what's actually driving it, it's very different than in the past when it's been driven more by job losses.